Microsoft reported quarterly financial results that sent the stock price lower. I'll review the financial figures. I'll highlight specifically what is sending the stock price lower, and then I'll answer if I still think Microsoft stock is a buy following these quarterly financial results. I'll do all that in this short video, so let's get into it. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right, so overall, Microsoft reporting second quarter revenue of $69.6 billion, which was up 12% from the same quarter last year. From its three segments, the one that grew the most is the intelligent cloud business, which increased by 19%. The company's gross profit margin came in at 69%, which is one of the best gross profit margins of any business in the world. Its operating profit margin jumped to 45%, and that was a total of operating income of $31.7 billion. Microsoft operates one of the most lucrative businesses in the world, generating hundreds of billions of dollars in annual revenue at operating profit margins north of 40%. Very few businesses can boast those kinds of results. Additionally, Microsoft reported commercial bookings year-over-year revenue growth of a whopping 67% in the most recent quarter. Commercial remaining performance obligations jumped by $40 billion up to $298 billion. Most of that increase is driven by commitments from OpenAI to Microsoft. OpenAI, ChatGPT, they purchased their computing power from Microsoft, and so Microsoft benefits from the relationship in that regard. But if you were looking at why the stock price is falling, it has to do with the Microsoft Cloud business. Microsoft Cloud revenue came in at $41 billion. The year-over-year growth rate came in at 21%. Now, those numbers on its own are solid numbers, but the reason why it's causing the stock price to decrease is twofold. First, the year-over-year increase in revenue growth has declined for a couple of consecutive quarters, falling from 24% in the second quarter of 2024, down to 22% in the fourth quarter of 2024, and now down to 21% in the second quarter of 2025. So you're seeing that decline in the year-over-year rate of increase. The second derivative is decreasing. What's more, the margins are falling. The gross margin in the cloud business has decreased from 72% down to 70% in the most recent quarter. So the rate of increase is falling. At the same time, the margins are decreasing. And the reason the margins are decreasing is because Microsoft is spending considerable sums of money developing its data centers optimized for artificial intelligence. These are the same capabilities that Microsoft is then turning around and selling to OpenAI and ChatGPT and other companies as well. That's where it's generating those commercial remaining performance obligations of $298 billion. But if I was an investor in Microsoft stock, I don't own Microsoft stock, but I have had the stock rated as a buy for some time now. I would be happy with these results. The company is spending on developing its AI business because it's seeing the customer response. The commercial remaining performance obligations, some of which is related to AI, not all, but some of which is related to AI, is absolutely soaring. It's jumped by $40 billion from the previous quarter and then over $75 billion from the same quarter the prior year. And the rate of increase is increasing from 17% to 30% to 67%. So you're seeing the tangible results in the remaining performance obligations in RPO, and so it justifies further spending in artificial intelligence. In more good news for Microsoft, the personal computing segment, Windows OEM and device revenues, increased again, and the rate of increase is now increasing finally. The company reported 4% increase in Windows OEM and device revenue. That was a 4% increase from the same quarter last year. The previous quarter, they only increased the segment by 2%. The quarter before that, it was negative 1%. So we're seeing improvement here in the personal computing segment, a segment that has been troubled. The PC industry has struggled to generate growth in recent quarters following the surge in 2020 and 2021. It's good to see this market finally rebounding. This is going to be good news for many companies that operate in the personal computing industry. Intel is scheduled to report quarterly financial results. They are likely to be more optimistic now that after I see these results from Microsoft, I'm expecting better figures than I previously thought from Intel. Not hugely better, but slightly better than I was previously expecting given these results from Microsoft. So as I mentioned, investors were not happy with that decelerating growth rate in the most important segment for Microsoft, along with the decreasing profit margins in that segment. The company's forward price to earnings ratio is now down to 27.74. This is the cheapest you've been able to get Microsoft according to this ratio going back all year. Furthermore, my discounted cash flow valuation has Microsoft's intrinsic value per share at $447, and the current market price is $415. In this intrinsic value per share, I would say that it's slightly undervalued, or you could say it's fairly valued given an appropriate margin of safety here to compare my intrinsic value with the current market price. So in any case, you're getting a forward PE at the lower end of where it's been for the past year, and you're getting a market price that's lower than my intrinsic value. And that comes on top of the fact that Microsoft is an absolutely excellent business. And so when I'm looking at an excellent business like Microsoft, I'm happy to get this business at a fair price. I don't expect to be able to buy these kinds of excellent businesses at cheap prices. And so to get this opportunity at a fair price, I think it's a good opportunity for long-term investors. So for that reason, I will update my buy recommendation of Microsoft stock and reiterate the fact that I believe that it is a buy on this dip here. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.